how do you think about someone allocating, from what they know and diversifying that into something that they also don't really know or that's new to them, like alternatives?
I would actually argue that a lot of alternative investment strategies are easier to understand than public market. If you can really simplify a description or an explanation of what an alternative investment strategy is, I think it can make a lot of sense.
All right. Welcome to another episode of the Legacy Wealth Podcast, where we help accredited investors build their legacy by growing their monthly passive income through private investments. I'm your host, Pascal Wagner, and today we have on the show Brannon Fisher, also joining here from Denver, Colorado. Welcome, Brannon.
Thank you. It's good to be here. Appreciate it.
Yeah, man. I'm excited to continue our conversation. So, to set a little bit of context, I met Brannon at a local investor event a couple weeks ago. We were at the DLP Capitals. They had like a dinner where everyone could come in. You know, existing investors could come and can learn about the fund, and then they could bring some friends that might be interested in learning about it. And we had this really fascinating conversation around his background and how he advises clients to invest in this space. So to give some background on Brannon, he joined Simon Quick, a financial advisory firm, in 2019 and established the firm's office here in Denver. He focuses primarily on business advisor for another Denver-based asset management firm. So he's been here for a while. And among many accolades, Brannon is a certified financial planner. He holds degrees from Colgate University, CU Boulder, and Dominican University of California. He is the president of the Rocky Mountain Estate Planning Council. He serves on the finance committee for the Ball Brothers Foundation, and I mean a lot more. He had a ton of accolades to share, and ultimately why we have him here on the show today is because he advises people on how to invest a lot of money. And I thought, what a great person to have and tell us how we might be thinking about it. So to kind of get us started, couple of the things I want to cover in this episode include: why do some passive investors work with a financial advisor and others don't? Like, when does it make sense to work with one, if ever? And really diving into how you advise clients and the way you think about the world of investing. So to set the stage here, how large is Simon Quick? What does the firm specialize in? And what problems do your clients have when they come to you?
Sure. So Simon Quick is a 20-year-old RIA, meaning that we are registered with the SEC. We're independent of any brokers or banks. And that model of wealth management attempts to minimize the conflicts of interest or product bias that you might find in certain parts of the market. So we have about $6 billion in client assets that we manage. Our clients are nationwide. There are 80 employees at the firm, and we're employee owned. About 26 of us are owners, including me. And we're really aligned with our clients in terms of the strategies that we recommend, because 14% of that asset base that I mentioned is employees and their families. So we're eating our own cooking in a way that I know is important to you and to some of your listeners. So I think that that's something I wanted to just say up front.
No, I love that. And one thing that just kind of tipped me off at the beginning here is this idea of being independent from banks and how that influences what products you push. I would love to dive into that.
Well, we don't push product. That's the point. People pay us for our advice. We don't have products, and we try to be agnostic about what investment managers we allocate client capital to. So the point is, we're a fiduciary for our client, and we have to put their interests first and make decisions that are in their best interests. And as certified financial planners, that's the standard that we're held to.
So, at what point what problem is someone trying to solve when they get introduced to you?
That's a good question. So typically their financial situation has just gotten more complex. They might be an entrepreneur who's selling a business. They might be an executive who's got complicated stock compensation and they need help sorting that through. Or they might be a part of a multi-generational family where there's a transfer of wealth happening from one generation to the next. And we take the responsibility of managing that wealth off of the client's shoulders so that they have the freedom to pursue what matters most to them. So we're a trusted advisor providing holistic advice to people who have generational wealth. In other words, more money than they expect to spend during their lifetime.
So how do you make money?
We are paid a management fee that is based on the size of the client's account. So it's a fee schedule, and starts out as 1% on the first 10 million, goes down to 85 basis points on the next 15, and so forth. So it's a regressive schedule. And that is the only way we're paid. We're not paid by investment managers or broker dealers or anybody else.
And why pursue that path actually, let me take a step back. When you say based on their account, so like they have a bank account with you and they transfer their money into it and then you redeploy it?
Sort of. So since the Madoff scandal days, RIAs like us have been required to have a third-party administrator, a custodian that manages, that holds the assets where we're advising. So that might be Fidelity, it might be Schwab, it might be Pershing. We use all of those custodians. And I think it's important to understand that the client has direct access to that account. They can fire us and replace us with a different advisor anytime they want. But they provide us with access to their custodial account to make trades into certain investments and out of others. So it's not a bank account per se, it's an investment account, and we advise on that.
Got it. So I'm just thinking about my portfolio. I open up my Fidelity. I've got maybe my individual account, and then I've got my Roth IRA account, and then there would be a separate account that's opened up in my Fidelity, and it's a custodial account that both you and I have access to, and then that's where you're advising and maybe allocating capital.
It could be a new account. You could also make us the manager on your IRA or on a 401k or any other kind of account that you might already have with that custodian, so that we could also make trades for you there. And that's what some of our clients do. They simply move the assets over so that they can be managed by us.
Understood. Okay, so talk to me through, you got into this field of advising, and I sit here on a little bit in a different part of the industry where I'm more of a fund manager, and I'm looking for funds to partner with, and we split. Our incentives are aligned around performance. And you've chosen this career path of going down an advising route. Maybe help me understand, why someone would choose maybe your path versus this fund manager path that I'm going down.
Sure. So I think I'll back up a step and just explain what my previous career was, if that's okay, because it informed why I'm doing this now. I was a college administrator. I was running a development office for a small college on the East Coast. And in that role, I was a trusted advisor on the philanthropy side for high net worth families. And I enjoyed managing those relationships and helping them through important decisions that impacted the present and future of their family. So when I decided to make a career change into wealth management, that was one of the experiences that sort of informed the path that I took into this career. So what I do as an advisor is provide holistic advice to our clients. And that starts with financial planning. The financial planning that we do actually dictates the asset allocation and the portfolio of investments that follow that. So the first thing that happens is we create an investment policy statement for the client. And that's where we lay out what their return expectations are, their risk tolerance, their income needs, their liquidity needs, cash flow.
All the boring stuff that are on the sheet of paper that someone sends you and you fill it out and it's like, what's your, where are you at? That stuff.
Yeah, that stuff. And, it might be dry, but it's important to do because, then your investing becomes more strategic. Right? It's not, you're seeing the forest through the trees, and it's our job to stay at that high level. And anytime a client is thinking about, I'd like to think about investing in real estate, or I'd like to get more involved with venture capital or whatever it might be, we have to sort of bring the conversation back and remind ourselves what their financial goals are. It's all driven by what their goals are. And if the decision is aligned with those goals, then it's easy to do. If it's not aligned with the goals, we have to understand why and maybe change the goal, right? So that's kind of where we sit as the financial advisor. And it's not just investing. Of course, we want to make a lot of money for our clients, but we also want to save them a lot of money by being efficient on the tax side and making smart decisions about what entities to form with their estate planner and so forth. So it's both estate, it's financial planning and investment consulting.
Okay, so you've talked a little bit about you're helping clients go back to their original investment goals. I've talked a lot about this, maybe in previous emails that people might have on my subscriber list or in previous podcasts, is this idea of an investment thesis. And, the way I've thought about my investment thesis is, I've wanted to invest in cash flowing assets until I have enough to meet my personal expenses, and then kind of dump the rest into high risk, high volatility, I guess, assets, but high reward. And so it's coming back to this investment thesis. And if I'm understanding you right, what you're basically doing is helping people craft that investment thesis and then basically help keep them disciplined to what they originally set out to do. Is that what I'm understanding?
That's all correct, but I would go further in saying that we have a very robust internal investment research capability. So there are 6 certified financial analysts who have a lot of training and experience in analyzing investment opportunities, who are looking at upwards of 600 different funds a year across asset classes and doing a lot of deep due diligence. And at the end of the day, we have a platform of 70 different investment managers that we use to custom construct each client's investment portfolio. So a lot of our clients either don't feel equipped to do that due diligence on their own and decide how to allocate their assets, or they don't have the time, right? They might be busy people and prioritizing other things. So they have offloaded the responsibility of doing that research to us. And I think we all have blind spots or areas where we are less expert than others in terms of investing, right? So some of our clients might be hedge fund managers who are really good in that asset class, and they can certainly invest their own capital there, but they might not know as much about investing in fixed income or investing in the public equity markets or that kind of thing. So, clients come to us for all different reasons, but I think a lot of them are just either unwilling or unable to have the kind of rigorous discipline that you have. They just might not be interested in doing that.
So I find that when it comes to investing, there is a large continuum of, there are investors who, I think when you're a teenager or when you maybe have your first little bit of money when you're in your 20s, you invest in something because your friend says it looks good or it's going to go up, right? And you do like really no due diligence. And then, that can span all the way to, you have an entire family office investment team. If you, have huge, large sums of capital where they're doing this kind of due diligence, kind of for you or on behalf of the family office. And then maybe like you sit somewhere in between that where someone can hire, it's kind of like maybe like a fractional family office or advisor in that way. And I think, when I don't have a financial advisor, and one of the things that I'm asking myself, and I thought would be a good reason to have you on the show is to talk through it. When does it make sense to hire one? I mean, in my eyes, I am very much thinking about how do I become a better investor? How do I surround myself with other people who are doing due diligence on the same types of things that I'm looking into? I can crowdsource. Why people like a fund and why people don't like a certain fund, and I can kind of gather all that and take all these differing opinions. And maybe you would say, I have the time and this is my career. And so it makes sense for me to do that. But for people who don't have that time, maybe it makes sense to work with an advisor or it's like where does that transition happen, or how should you be thinking about whether, just to add one more point here, it's like, I've always had this notion that I'm going to be a better steward of my capital, or at least I have a much higher incentive for allocating my capital properly. And so, I've kind of like shied away from hiring a financial advisor, but maybe that's a limiting belief. Talk me through that.
Sure. No, I think you made an important point about the commodification of wealth management. I think there are large parts of this profession that are being commoditized by technology, by so-called robo-advisors. It is possible for people to find good investment opportunities without paying much for that, because information's available to everyone, and so forth. But I think you also mentioned a couple of minutes ago the term family office, and that's the small niche market where a firm like ours plays. So I don't think that part of the wealth management spectrum can be commoditized or can be replaced by robo-advisors. What we're doing is very personalized to the client. It requires trust, and it requires that we understand all of the stakeholders in that client relationship really well. And I think the folks that need to think about having an advisor relationship like the one I'm talking about are the people that feel like they have more money than they will likely spend in their lifetime, because the importance of having a team of advisors working on your behalf, and typically wealth management firm like ours is the quarterback on that team, but that team includes trust and estate attorneys, CPAs, life insurance brokers, and perhaps others who have the ability to sort of steer you in the right direction over the long term. It's important to have a trusted team around you if you are in that space. And oftentimes, really wealthy families, like 500 million or more, will create a single family office, and they'll simply hire a staff internally to do those things for them. But if you have between, let's say, 10 million in net worth and 500 million in net worth, you might consider a multifamily office firm like Simon Quick to help perform all of those things that we've discussed: investment consulting, financial planning, and family office services, which some portion of our clients ask for. That can mean anything from bill pay to property management to bookkeeping for our clients that have really complex asset holdings.
So I'm hearing that, working with a firm like yours, as if you're in the 10 million and above group, I sit around the 5-6 million in net worth area. And I've had to pull all of those resources together myself, right? Like I have, I'm not working with an office that provides all of those things. I've had to go out and do my due diligence and find an estate attorney and find a CPA and find a life insurance. I've done everything you listed. I have a different person for each one of those. So is that something that if you're below that threshold, that it's just you need to go out and find those people and you need to be educating yourself about? Or
not necessarily. I think there are good advisors for what we call the mass affluent sector, and those firms, if they're good, will do the same thing that I've done very intentionally over the last 5 years, which is to build a network of complementary advisors where I can refer clients if they need that, right? So as we're getting to know a new client and we're reviewing their trusts, we're reviewing their estate plan and their insurance program and things like that, we might find holes in their program. We might find places where we think they need to update their estate plan or that kind of thing. And if they don't already have a good advisor in that area, certainly we can suggest ones that we trust and we know will serve them well. So I think it's good to have a team. You mentioned that you've kind of tried to put together a team. I think that's exactly the right approach, and you want that team to sort of row in the same direction together, right? So they should all be talking and working together on your behalf.
So when it comes to the types of things that you're advising on, so, you mentioned that you have like 77 different funds that, your analysts have gone through and they do 600 funds a year, and they've dwindled them down to these that meet your criteria. Is that criteria that you can share that all of those funds kind of pass?
I at a high level, I can do that. I'm a client advisor, so I'm only peripherally involved in the research process. We have, like I said, an internal investment research team that does that. But the due diligence process that they do, they're looking to understand the manager's track record. They are looking to understand how experienced the management team is together. Like, have they demonstrated an ability to execute on their strategy together? And we're looking to analyze all different kinds of risk, right? Whether that's key man risk on the executive team, whether it's other kinds of risk within the fund manager's organization, whether the strategy itself is at risk of being relevant or of being successful. We're also looking to understand what other kinds of LPs they have in their fund, right? Are there other institutional investors like ours investing? We certainly don't want to be the biggest investor in their fund. We want to make sure that they have the right processes in place in terms of reporting and compliance. We want to make sure that their systems are robust so that they're not going to be victims of fraud or cybersecurity intrusions. So all of the things that you might expect, just asking a lot of questions and coming to understand and trust that manager the same way we would if we were a client looking for a wealth manager like Simon Quick, right?
Yeah. So it sounds like the investment firm pretty much does all of the basic due diligence that you would expect a standard LP investor to do. Like all the things that you mentioned are things that we as investors, when we're looking at these deals, should be doing if we're not working with a firm like yours.
Right. So, for example, I have a client who met a private equity fund manager, and this guy pitched him. And so the client came to me and he said, I have this investment opportunity. I think I'd like to do it. And I said, well, how many other private equity managers have you talked to? Like, how do you know this is a good one or a bad one? And what kind of research have you done? What kind of context do you have? And he kind of got quiet, and I think that's important. Like, I don't know that a typical person on the street always has the ability to access the information they need to make those smart decisions. I think you put it well when you said you crowdsource it, right? Well, some people don't crowdsource it. They just, they get caught up in the moment and they go with their gut or something. And that's kind of what we can avoid doing by investigating and researching the entire spectrum of managers in a certain strategy, and then picking best in class so that we have a lineup of world-class managers that we really trust and put our faith in.
I'm wondering if, and you might not know this or can't share, but one of the things that comes to mind is do you look for funds that have never lost investor capital, or is that up until this point, I've thought losing investor capital is a big red flag. On the other hand, I think it depends on how the management firm deals with the loss of capital and how much they communicate, and if they've had a stellar track record since then. If that's like an awakening moment, and do you avoid those types of funds, or how do you think you view that?
Well, it's a good question. I think our mandate usually is to preserve wealth. People come to us after they have made money, and the old axiom is you get rich through concentration and you stay rich through diversification. So we are in the business of allocating to a diverse portfolio. And I would also make the point that some of our clients have a very low risk tolerance. Others have a huge risk tolerance. So, we've got a minority of our clients coming to us and saying, hey, I want exposure to cryptocurrency. Well, if we have approved a hedge fund, a long short hedge fund in the crypto space, we can't guarantee they're not going to lose money. You know what I mean?
Right.
Like, there's a ton of volatility, and if the client has a desire for that exposure, certainly it's our job to make them aware that they're taking that risk. But if we feel like we have found the best manager in that strategy for them, we will allocate a small percentage of their capital, whatever we agree is responsible, and they're going to go on that roller coaster ride, and they will almost certainly lose money at some point, but then they might make it all back and then some.
All right. So we met at the DLP Capital Mastermind Dinner, and I'd love to understand, why were you there? Were you already an investor? Are you new to the fund? Are you learning about it?
I was there because I know a couple of folks who work at DLP, and they invited me there. And we are looking at DLP as a firm, among many other real estate fund managers. And I made it clear to them when they invited me. I said, "Look, I'm not allocating on my own, but I'd welcome the opportunity to learn more, certainly." And they were kind enough to have me as a guest there. But yeah, we're in the due diligence process there.
Got it. So you're basically there trying to decide, like, what kind of information do you get from attending a dinner like that in your eyes?
A couple of things. I'm there looking to see what kind of LPs are in the room. So who is the investor base for a fund like that? Also trying to understand the expertise, the level of sophistication from the manager themselves. What kind of presentation they give, and I think you can also just kind of understand the way that they interact together, right? There were probably 5 or 10 different people from the firm there, and you get a sense of how they treat each other, how they treat their LPs, and that gives you a sense of the kind of partnership you can expect if you become an LP.
What is the diverse? So you said you're there to look at LPs and see, what kind of LPs are in the room. Can you walk me through an example of like different, 2 different sides?
Sure. So what I mean by that is some funds, typically there's like a maturation cycle, right? So fund 1, if a manager is just new to the space and they're starting out, their investors might be friends and family, and they're going out to people that they know and who trust them. And they're asking them to get on board with this first fund. They don't have a track record. There's nothing really more to rely on than their, do you trust this person as a person, not as a fund manager, but as a person? So if they demonstrate competency in fund 1 and they're going to do fund 2, they can take that track out to other prospective LPs. And that typically would be high net worth individuals, maybe some family offices. And it's not typically until fund 3, when they are now raising more capital, let's say 100 million or more, that institutional investors like an RIA, like Simon Quick, or an endowment foundation, or even pension, something like that, might come and invest in that strategy. Because by fund 3, you have a sense of whether they're, what kind of returns can you expect? What have they demonstrated as their excellence and their expertise and all of that? So if you're in the room, you're looking to see, okay, who are the family office executives? Who are the RIA executives? You can sense how institutional is this manager.
I would imagine you have a preference towards more institutional managers than not.
Yes, but that's not to say that we don't like small. We don't like small funds, right? And it's all relative. By small, I mean 100 million to whatever, 250 million. But it depends on the strategy. But there's a sweet spot where a manager has done a fund before and they've demonstrated competence, and then you've got the ones that are so big that they've lost their edge and they're not personal anymore, and their returns might not be quite as good as those that are younger and hungrier. So I do think there's a sweet spot in there somewhere, in that growth cycle where you want to invest with a manager.
So given that this is your career and you have these 77 funds that are approved, do you only invest in those funds, or do you invest outside of what that kind of firm, I guess, approves?
It's a good question. There's a sort of a term in our industry called wallet share, and the question is like, how much of your client's wallet share do you actually have, right? And in some cases, somebody might sell a business for 20 million and then turn to us and say, here's $20 million. This is all I have. And now you're responsible for it. In other cases, they might have a net worth of $100 million and only give us 20 million of that. Right. So that's okay. And, sometimes we're not the only advisor that a client has. They might have us, and then they might have a big wirehouse bank doing some other things for them, including lending them money. But I think that, I'm not sure if I've answered your question, but I think a lot of our clients will do some investing on their own outside of Simon Quick. They have, an interest in real estate or some particular thing that they're really good at or interested in. And certainly I would encourage them to keep doing that.
And I'd imagine it's the same for you. Like, this firm has certain things they approve, but you also were investing before you were at this firm. So I imagine you've invested across all different things, not just things that are like recommended by your firm.
Yes. And, I think, sometimes our firm makes decisions about what managers to bring onto the platform that are based on things like, okay, how broad of an appeal is this going to have in terms of our ability to, use different clients' assets in this fund, right? So if it's only a handful of our clients who might be interested or appropriate for a certain manager's strategy, we might not approve them. But that doesn't mean they're really good at what they're doing, right? So to answer your question, yeah, there are fund managers out there where I know them, I like them, I invest with them, even though they're not approved at Simon Quick.
Right. Do you use, I want to take a step back and kind of go back to this notion around the investment thesis. And I think jokingly earlier, I was like, okay, the boring stuff, but I think maybe 5 years ago or 10 years ago, I thought that was very, very dry and boring, but I now geek out on it. Do you use that to craft your investment thesis, or is it kind of like a sliding scale of guidelines? Like, how do you use this, questionnaire that kind of every financial advisor has their clients fill out and in detail kind of craft that into a strategy?
Sure. Well, let me give you just an example, and then we can expand on that if it's appropriate. But every investment policy statement has asset allocation targets. So it could be, the target could be 50% equities, 30% fixed income, 20% alternative investments. That's just an example. And within around those targets, you might have ranges. So, the range for equities could be 40 to 60% or 30 to 70%. And then, depending on macroeconomic conditions, depending on the way or geopolitical concerns or any other kind of external factors, you might decide to go underweight a certain asset class and overweight in another. For example, today, Simon Quick's investment committee is recommending that we are underweight in equities, overweight in fixed income, and target weight in alternative investments. And there's a lot of nuance there, but that's kind of the headline. And what that allows us to do as advisor teams is look at each one of our clients' portfolios on a regular basis and decide where we need to rebalance, right? And we're always taking a very tax sensitive approach to this, but in order to help them navigate the winds of macroeconomics and markets, we need to be paying attention to what our investment committee is recommending.
Do you start with an allocation by instrument like this, debt, equities, alternatives, or do you, at the beginning I mentioned this kind of thesis around, focusing on cash flow first and then higher volatility assets after I've reached, covering my personal expenses. Do you always, what's the order in which the investment strategy is decided?
Mm-hmm. We do start with asset class, so super class, right? Equities, fixed income, alternatives, and cash. And those decisions, those targets are informed by whatever the client's needs are, what their time horizon is for accomplishing their goals, and so forth. And then we're within those buckets. We'll look at cash generation and growth over time. We'll look at asset location as well. Like, what do you put in the client's taxable account versus their IRA or whatever tax sheltered account they might have.
Interesting. How do you so when you say equities, you mean the stock market? Because when the other thought that comes to my mind is equities is like you can get an equity based position in this alternatives allocation bucket, which is like investing in real estate and so when you're saying equities, anyone says equities, markets. It's public markets.
Right. Yeah. And we're not stock pickers. I think that's very hard to do, to beat the market, so to speak, by picking individual businesses that you want to invest in. But what we do is select managers who are great stock pickers, and they create mutual funds that are, the vehicle for investing in whether it's small cap domestic or large cap international or whatever, value or growth or different areas within the equities asset class. And we try to give our clients exposure to all of it within the equities class. Sometimes that's through passive vehicles, and sometimes that's through active management, whatever is the right fiduciary choice.
So you've talked a little bit about you're helping people, you're advising people, you're giving them suggestions and if I had $1 for how many times I've heard people say like, oh, I lost money because my financial manager recommended X, or, the initial thing that I come to there is, I think it depends if you have this, I'm ultimately responsible for my capital and I'm leveraging the financial advisor literally as an advisor. And I take their feedback and then make decisions. And then I think when I hear this statement, I think that their mindset is more, oh, I'm parking capital with them and then they are responsible for growing it. Which is the more appropriate lens that you think people who work with financial advisors should look through?
Well, I would hope it's the more collaborative approach. I love it when our clients are actively involved in decision making and they view our relationship as a partnership or a collaboration. That's much more rewarding, and the outcome is almost always better if you've got both parties working together to make the right decisions. Certainly, sometimes we have clients who are either too busy to be involved or they just don't feel equipped to make, informative comments to us. We also have clients who want to know about every decision that we're recommending, and that's okay too. We will send them our due diligence reports on a certain investment and say, there's $100,000 cash in your account and we'd like to make this investment. What do you think? And that's okay too. So we work with the whole spectrum. I can tell you that from my perspective as an advisor, I most appreciate the clients who want to stay informed and be involved and have a voice.
I imagine, it may be different if you have clients that have more money than God, that are, won't be able to spend that in their lifetime. I imagine that kind of, maybe that mindset's different, maybe it's not, than those who are, I don't know, starting to retire and want to enjoy the finer things in life, and they, just want to hand that off.
Well, that's all true. And, I think the term financial advisor can mean a lot of different things. And I know it's outside of the scope of this podcasts, but a lot of the conversations I have with clients aren't necessarily about investments. It might be more about relationships with family members. It might be more about philanthropy. It might be, about what their expectations are for their kids, right? If you have a lot of money, how do you raise responsible, productive kids? We talk about a lot of those things too. And I think that's in some ways the most important advice that we can provide.
Talking about advice, we're kind of making a segmentation here between like 10 million and above, the clientele that you work with, and then the 10 million below. And we're kind of painting this picture of like, if you're below that threshold, you kind of need to go source and do a lot of these things yourself. You have to go find an estate attorney, go find a tax attorney, so for people that are in that 5 to 10 or 2 to 10 range, and they're getting into looking at different funds and fund managers and trying to figure out who to place capital with, it's not investment advice for them, particularly because they don't, know their situation. But like, what are some maybe tips or things that you think about that you wish people would do in this asset demographic?
Well, I think mostly what you're focused on with your audience are alternative investments, right?
Yep, correct.
I would view those alternative investments in two categories. You've got diversifiers and you've got return generators. And so when people get to the point where they're an accredited investor or a qualified purchaser in the eyes of the SEC, chances are they should be starting to add alternatives to their portfolio. And I think that they should think about those alternative investments in those two ways. Is this going to help me because it diversifies my portfolio and gives me uncorrelated, exposure, access to an asset class that is uncorrelated or perhaps inversely correlated to stocks and bonds? Or is it something that is going to potentially give me a much better return than I could find in those two asset classes that are more available to the masses, right? So you might want to have both, or you might want to have just one or the other. I think it depends a lot on your, where you are in life and how much more money you anticipate being able to earn and add to your net worth during your lifetime.
Yeah, so let's maybe specialize there. I like to talk to business owners here. Businesses that they're growing. They've already reached maybe 5, 10, 20 million in revenue, and the owners have a lot of cash. There's maybe 10 or 50K coming in a month. I was just talking with a client yesterday, and he was like, "Yeah, I have 600K, 800K just sitting in my account, and it keeps piling up from the money coming in." And like, first off, great problem to have, but second off, it's like, they're trying to figure out what to do with it. And being a business owner myself and knowing that I've built a lot of my cash flow through concentration, I've started to realize like, wow, there's a lot of, if COVID happens or if supply chain issues happen, or I am very much up a river and with nothing to show for it if I haven't diversified. If you're thinking about a business owner, how would you change or maybe add on to that statement?
Well, I keep thinking about how this all comes back to somebody's age, right? And it's income, of course, but it's also how old are they and how much time do they have, how much runway do they have to continue to build wealth. And I don't think it matters so much whether you're a business owner or not. One way of viewing business ownership is that you've got a concentration in private equity exposure, right? I mean, that's what that is. You own equity in a business and you have a concentration risk problem. So if you are thinking about investing in other alternative investments, the logical thing to do would be to find investments other than private equity. You've already got plenty of that. right? So what you need are things to complement that.
Yeah, that totally makes sense. I also think that, the thing that is most publicly available to everyone, and probably the first thing in the food chain that you can invest in is public equities. And if you've never invested in alternatives, it can be a very confusing, scary thing. How should, obviously, maybe I'm a little biased. I probably make most of my money in alternatives, and so I only have a couple $100K in the stock market at this point. And so, how do you think about someone allocating, from what they know, or what they think they might know? That I'm sure, as you grow up, not everyone's an expert in equities. I'm not, and diversifying that into something that they also don't really know or that's new to them, like alternatives.
I would actually argue that a lot of alternative investment strategies are easier to understand than public markets. I think there's so much noise in the public markets, and there's so much leverage in the public markets sometimes that it's difficult for people to understand why numbers are going up or down, right?
Right.
If you can really simplify a description or an explanation of what an alternative investment strategy is, I think it can make a lot of sense, right? Sometimes it's a tangible thing like real estate where you can see it, you can feel it, and that sometimes is easier for people to invest in, a real asset. Or maybe it's a direct lending strategy where you say, look, you give me this capital, I'm going to take it and make investments. I'm going to, make loans to businesses to help them operate. And then we're going to get a return off of their successful operation of that business. So it can be, from a conceptual level, easier to understand some alternative investment strategies. Problem is that it can be harder to access them. Right. And I think what you're doing through your business is helping solve that problem. We try to help solve that problem too. 35% of our clients' assets are allocated to alternative investments.
Yeah, part of what I'm realizing, first having worked Techstars at a venture capital company, and now really diving into this limited partner investing space, it really comes down to just access and education. Like, 5 years ago, I didn't know where I could go find an oil and gas deal, and like you can go look them up on Google, but like, how do you know which one's good? And how do and so very much just access and education. What's your take?
Well, I think you're right. There's a reason why they're more difficult to access. I think because they're less regulated than the public markets. You have to meet a certain level of accreditation. You have to be an accredited investor, or you have to be a qualified purchaser, which requires an even higher net worth. And, they're trying to look out for people and make sure that they don't lose it all on some bad investment. But at the same time, I think some alternative investment managers are finding ways to make it easier to invest in their strategies. For example, the advent of the evergreen fund structure, I think, is really helpful. It allows firms to bring down the minimum investment commitment. So instead of the old days where you might have to make a $1 million commitment to a private equity fund, and then they would go out and look for investments and call that capital gradually over 3 to 5 years as they find the right companies to invest in. That can be really difficult for somebody who's got a couple $1 million net worth. But now, there are funds out there that have an evergreen structure where you can commit $50,000 and right away they'll call all of that. And it's locked up for maybe a year or two, but after that, if you need the money back, you can get it back. It's not the traditional like 10-year fund structure where you're illiquid for the duration of that time. So I think that's really helpful that firms are able to lower their minimums and able to create an evergreen structure where there's more liquidity.
There's also one kind of final point I think I'd like to get your take on, which is I've been asking myself, and I've been getting these questions from different people on my social media channels about, there's different levels to this game. There's going to the Fundrise, Yield Street, the public, tech company platforms that make kind of private placements publicly available. And then there's a different segment of the market where you need a little bit more cash. You maybe need $50K instead of $500, or $100K. And with those, what's the difference between a platform like that versus going into these other ones? And my answer, as I've kind of started to scour through Fundrise and Yield Street, and I'm finding that I'm able to find funds with less fees or better returns. How have you how do you view the landscape? And if someone's like, what's the difference between all these different platforms and private versus public? How do you look at that?
Well, it's a good question. I'm not sure I have much expertise there. I think that that's probably much more your area of expertise than mine. I will say that when it comes to accessing certain alternative investment managers, what we're able to do that an individual can't would be to negotiate down the fees and the minimums by aggregating our clients' capital. So if a minimum to get into a hedge fund is $5 million, that's a pretty big commitment, even from the most wealthy families. So we can go to that manager and say, we'll bring you $25 million as a firm, but we would like to be able to lower that minimum to $1 million, right? So it makes that manager more accessible to more of our clients and helps get them exposure to world-class managers that they might not be able to access on their own.
Totally. Yeah, I'm very much doing, I don't know if I'd go out on a limb and say that, but I'm doing something similarly as you, where I'm aggregating capital into deals. That's like an example of the DLP lending fund, right? Like you need to have $200K to invest in that fund. And we're creating a feeder fund to allow people to invest with $50K. And so that enables them to get into a higher product, without that much commitment, but maybe without the financial advice.
Sure. No, I think that's exactly right. You're accomplishing the same thing.
Yeah. Brannon, this was awesome. I love this. Where can people go find you if they want to contact you to learn more, just have a conversation with you?
Sure. My email address is bfisher, that's BFISHER, at simonquickadvisors.com, advisors with an ORS.
Awesome. I'll be sure to add all of that in the show notes. But thank you again for joining us, Brannon. And I'm looking forward to meeting you soon. Soon.
Yes, it's been a pleasure. I appreciate you having me on. It was a lot of fun. Thanks, Pascal.